It's 2022 and the market in 2021 was absolutely scorching hot with the S&P 500 up almost 27%. But all isn't well as warnings of an impending market decline are getting louder as the rate of inflation recently hit a 39-year high. So should we be optimistic going into 2022 or should we be a little bit more concerned? That is exactly what we're going to be covering in this video, so smash that like button and subscribe if you're new. You're watching More Money, let's get it. Alright guys, as 2021 has come to an end, the market just roared in the year with the S&P 500 up almost 27%. But it doesn't look like all companies fared equally. The large technology companies seem to have fared much better with the Vanguard Technology Index Fund ETF up 32% in the year. And what the story here really is that technology fared a lot better than the overall market, which you can get an indication of as the Russell 2000 was up just over 15% in the same year. So really it tells me that we have a situation where the S&P 500 is a bit top heavy with technology names, which is nothing new. I covered that in an earlier video last year. We may also have some non-technology companies that are underperforming the market overall and could potentially be undervalued. And that's exactly what I was seeing throughout the year, and most of my portfolio is made up of unexciting, boring, undervalued names. One that I did cover prominently on the channel was Cardinal Health, and one that I gave to the Patreons was H&R Block. And let's be clear, I haven't purchased H&R Block just yet. I'm waiting for it to come down a little bit more because I'm super greedy. And guys, these aren't multi-bagger opportunities at all, but a consistent 10 to 13% a year is definitely great for my overall portfolio strategy. And these opportunities are important because they have the one thing that the high-flying technology names do not have in this market, which is downside protection, which is absolutely necessary in the current environment as we are seeing glaring warnings that the market is getting overheated. How exactly do these types of companies have downside protection? Well, it's two reasons. The first is that their business models are very strong. Their earnings are very sustainable. Pharmaceutical distribution and tax preparation are two things you can't really avoid in society. And the second reason why these names have downside protection is because their valuations are already so low. Now, am I saying that that's the only way to make money in the market? Absolutely not. Some people do like to play the game of buying high and selling higher, like Cathie Wood and Jim Cramer, but that's just not the game that I've liked to play over the year. And personally, I'm not saying that I'm even a Warren Buffett guy, because I even have trouble with Warren Buffett's strategy of buying an exceptional business at a fair price, because I really love looking for that big margin of safety, and I have the ability to buy into smaller companies that wouldn't move the needle for a guy like Warren Buffett. I do feel that if I'm successful enough, eventually my strategy will change. Okay, let's take a step back. Why am I focusing more on downside protection rather than upside in this environment? Well, because two common market valuation indicators are suggesting that there is trouble on the horizon. They are the Shiller PE ratio and the Buffett Indicator. And for those of you that are a bit newer, the Shiller PE ratio measures the price to earnings of the market by adjusting for cyclicality. The Shiller PE ratio is currently sitting at close to 40 times earnings, which is coming very close to where it topped out during the dot-com bubble. And that puts Charlie Munger's comments of things looking worse than the dot-com bubble into perspective. And just so that we're all aware, the average Shiller PE ratio is 17 times earnings, which is of course much more reasonable. I would have thought that it would be 15 times earnings, but I might be using old data. The second common indicator of the overall valuation of the market is the Buffett Indicator, which measures the stock market capitalization to the domestic GDP. And the more astute minds would recognize from that definition that this indicator is becoming less and less important as more and more companies are generating their earnings from overseas, but it's still used as one indicator in conjunction with others. And you can see here that the Buffett Indicator is currently sitting at over 200% of market value to GDP. This reflects a valuation that is 2 standard deviations away from the mean, which is firmly in the strongly overvalued territory. So the question really is, how can I make the news even worse for you as an investor heading into 2022? Well, here's how. The fears of inflation that we had in 2020 when the money printers were turned on to address the COVID lockdowns have now become a reality. And truthfully, we've been scared about inflation since 2009. Seth Klarman was adjusting his portfolio for higher inflation way back then. Massive quantitative easing in the levels that is currently being done is very new to us. We're only around 12 years or so into it. So there's still a lot that we don't know and we're learning on the fly. But the one thing I will say is any society that has massively inflated their currency has inevitably collapsed. Now, month-over-month inflation has now hit a 39-year high at 6.8%, which is absolutely insane. Prior to COVID, I honestly never thought that I'd see inflation north of 5% in my lifetime, but here we are. And I don't think that that CPI basket is reflective of the true cost of living. I think the true CPI could be closer to that 10% to as high as 15% area, depending on where the real estate situation is where you live and the surrounding climate, and how far away from work you have to commute to work on a daily basis. To put it simply, if you rely more on fuel to make your living and heat your homes, the odds are that things are going to be worse for you. And you'd be surprised with how many people in the economy this impacts, from gig economy workers to contractors to even just suburban commuters. So what does that mean for investors? Well, because Jerome Powell came out and said that we have to retire the term transitionary from our vocabulary when thinking about inflation, we have to anticipate that a rate increase will occur in 2022, and it may come earlier than expected. With rate increases, of course, comes share price declines. With that said, I truly believe that there are 3 important investment themes that we can be looking towards in 2022. To keep this video somewhat short, I will briefly go through all of the themes here, and in subsequent videos in this series, I will be diving deeper into each theme to provide as much value to you as I can. And of course, to not miss out on those videos, please consider subscribing to the channel and hitting that notification bell to be notified when I release those videos. I'm absolutely shocked that 1 in 5 of you are hitting that notification bell to be notified when I'm putting out these videos. It's really humbling that so many of you really look forward to the content on this channel, so I really wanted to say thank you for that. So the first investment theme for 2022 is housing. Despite the continued building in 2021, the US is still short something like 5 million homes. And this is really because there are just more households being formed than single family homes being built. Now, of course, this isn't a 1-to-1 ratio of families being formed to housing demand, but homeownership is a very real dream and still remains a cornerstone to American and Canadian life. Additionally, the labor shortages and supply chain disruptions have been putting strains on the industry's ability to close homes at the level of quality that's required. I think we have a long way to go in home building before housing demand is caught up to, especially in this new hybrid work from home environment. Valuations for these home builders has come up more and more as investors are realizing that this is a strong industry right now, so I'll be very selective with the companies that I'm investing in here. I like tract builders with limited inventory risk that are trading at lower multiples and have limited debt. This is becoming harder and harder to find, but I will absolutely keep an eye out. And guys, I have put my money where my mouth was. Late in 2020, my favorite name was LGI Homes, and I made one of my earliest YouTube videos on it, but as the share price unexpectedly flew from around $100 a share to $165 a share, I sold it and took profits. I would love to buy it again at around that $90 per share area, so if it declines to that area, I'll be looking to purchase it again. I'll even be looking to buy it with an attractive cash secured put opportunity, but the opportunities aren't there right now. Another home builder that I do own in my portfolio is a company that I did mention on this channel, which is Dreamfinders Homes. I wasn't able to buy the company with the share price that I was looking for, but I did sell a cash secured put on it with an annualized yield of 25%. I don't think the share price will come down for me to get exercise here, but if I do, I'm comfortably sitting at a cost basis which reflects close to 50% of my valuation. So this Dreamfinder Homes investment is a great example of how a value investor can use options to reduce risk. As I am super greedy, I would love to purchase more of Dreamfinder Homes sub $12 a share, which I think there is an opportunity at the moment. Let me know in the comments if you want me to dive further into that in a separate video. Theme number 2 is a bet on the alpha opportunity. For those of you that are newer to investing, an alpha opportunity is just an investment opportunity that has the potential to provide an excessive amount of return for the risk. And what I mean by that is that there are many large technology companies that are reinvesting their capital into research and development efforts to continue to change the world. Meta is doing this with their metaverse, Alphabet is doing this with their autonomous driving, and Alibaba is doing this with their investment into the cloud ecosystem. Any one of these companies can hit it big by creating immense value for society, so I'd like to dig deeper into which ones I'd consider investing in. You guys already know that I'm a huge Alibaba bull, so I'm not going to dive into Alibaba here. But I think Alphabet might be the winner here, as they have gone deep into autonomous driving with their Waymo segment, and this could provide immediate share price gains as they announce advancements. And what I mean about this being an alpha opportunity is that based on my valuation of Alphabet, which you can see here, I don't believe that any of this potential upside is being factored into the valuation for the company, as I have them trading at 90% of their intrinsic value with a low multiple and high discount rate. And the reason why I say 11.5% is a high discount rate for Alphabet is because their products are less price sensitive to inflationary pressures. And of course, I'm going to dive deeper into that in the alpha opportunity video. And a similar story is happening for Facebook, where Facebook's total valuation is just reflecting their ad spend, and it's not really reflecting any potential upside that they can get from the metaverse. And I think that they will succeed in this space. And to be honest, they believe in themselves so much that they just renamed themselves Meta. So that should give you an indication of how strongly they believe in the future here I do believe in them. But more on that in the next video. Finally, theme number 3 is the flight to safety. As the stock market is becoming more and more overvalued, I think one of the themes that we'll see being played out in 2022 is that more and more investors will be looking to reposition their portfolios out of higher value technology names and into less risky businesses with strong moats and lower valuations. And once again, guys, I actually started doing that back in the beginning of 2021 because I was seeing the risks. I'm still mostly in cash and I'm looking for more of these types of opportunities. And now you're seeing more and more as the market is getting spooked with threats of higher interest rates. The market is repositioning, which you can see with a year-to-date near 25% decline in Cathie Wood's flagship portfolio, the ARK Fund. And that's not a dig at Cathie. I will freely say that she's 100 times smarter than I am on any day of the week. I've just been following her for a while and I've never been able to get behind the valuations that her firm is willing to buy some of these stocks at. For example, when I started the channel in January of 2021, the first 3 stocks that I wanted to cover were Palantir, Zoom, and Roku. 3 of her favorites. But when I valued and built the models on all 3, I quickly found out that they were priced much higher than I was willing to pay for them. And a year later, we can see that other investors do agree with the conclusion, as Palantir is down 22%, Zoom is down almost 50%, and Roku, my favorite of the bunch, is down almost 30%. I think we see more repositioning as we proceed into 2022. So needless to say, be careful with what you have in your portfolio. Also, if you want me to build models valuing some of Cathie Wood's favorite names, let me know in the description below. I'll give you another side of the analysis here where you have a guy who says, show me how these companies are worth as much as they're trading at, because I don't see it. And you can see that line by line in the models that I would build for you. So let me know if you guys want that. I think we see more repositioning as we proceed into 2022. One area where I see some safety in an overvalued market is with businesses that have strong moats like pharmaceutical distribution. If someone gave me $1 billion tomorrow, I wouldn't be able to set up a distribution and sales network similar to what Cardinal Health has today. I actually made a series on Cardinal Health, which you can grab right here. Alternatively, when my deep dive on the first investment theme for 2022 is available, which is housing stocks, you'll be able to click into that right here.